All right. Thanks for joining us. We are going to spend a little bit of time talking about funding and a bit of a deep dive into investment, thinking about the different types of funds that you have available to you when you're trying to build a startup, and how you might go about engaging with those different types of funding sources and when they may or may not be appropriate based on your needs and stage of development. So, the big, I guess the main sources of capital, we'll talk about a few other ones in here, but the main sources of capital in the kind of innovation ecosystem for entrepreneurs is venture capital, angel investors, crowdfunding, and private equity. And there is some really nice gaps between these different groups, although sometimes they overlap, and they often are very much focused on different parts of the innovation system. So what are they? So different types of funding rounds. We've covered some of this in an earlier recording, but people have kind of notionally put some boundaries around different types of fundraising, and investors typically align with these different these different stages, these rounds. So angel investors will often do, a pre-seed, a seed, and maybe up to a Series A, and then they don't do much further. Venture capitalists will often do seed, Series A, maybe Series B. Some in the US will go a bit bigger. And then you get things like private equity, and they often don't do Series A, but they'll do Series B, Series C. And then crowdfunding, you can often participate in any of it. And so these different rounds refer to how early or late a company is in its development, which often means how much risk is still within that company. So early stage, like a seed round, there's lots of technical risk, there's lots of commercial risk, there's lots of customer risk, there's lots of founding team risk. But by Series C, you've often solved all the technical issues, you've got a good team in place, and your challenge is really just scaling. So it's a lot of commercial market risk, right? And so yeah, a bit more information here and a link that you can have a deeper look. So the amount of money that they often invest based on these stages differs. So a seed stage, could be anything from 20, 30, 40,000 USD, maybe a bit more, through to like a Series C, which might be 30, 40, 50, 100 million type of money. And then when you get ready for IPO, that's whatever the market's willing to pay for it. So like quite significant differences. They are a bit arbitrary, but you will find that investors are pretty attached to the types of rounds, to certain rounds. And so just be conscious of that. If you're going off and talking to a venture capitalist, take the time to have a look at their website, because if they say we're only interested in Series A, Series B, don't bother pitching to them if you're really a seed stage investment and you're only looking for $50,000. And vice versa. So just partly this is just about make sure you do your homework on the investors before you talk to them. So we've covered a lot of, I think we've covered this in the past, but really what happens when you take money from an investor, and it doesn't matter what type of investor it is, but if they give you capital, what they want in return is they want equity. And so that's some shares in your company. And those shares often come with voting rights, although not always. And you can, it gives them a certain ownership over some of the company's assets. So if there is a sale of the company at some point, they get a percentage of that sale. If there is a dividend to be distributed, they will often get a share of that dividend. And there's a few ways that you structure that. It'll all get articulated in your shareholders agreement that you'll need to make sure that you do, and investors will ask for. One of the really important things when you are out there trying to raise money is valuing your company. This is really, really hard to do, and there is no right or wrong. There are lots of wrong ways actually, but there is no right way to do it. You just often you have to do a mixed approach to trying to value your company, and you can do discounted cash flows. You can do comparable company analysis. So, like a company over there, they just raised a bunch of money. They've got about the same number of sales that we did, and they got it at this type of company valuation. So we think we're about the same. So, and often that's what investors will most often base it on. We'll be looking at comparables. It gets a bit easier as you get later in the development. When you think back through that Series A, Series B, Series C, often when you're that later stage, you've got enough revenue that investors will start valuing you based on a multiple of your revenue. And so that's often what happens. So if you look at businesses in the SaaS sector at the moment, maybe you're selling, I don't know, whatever it might be, it's a SaaS business model. Often people will say, well, you know, a mature SaaS business will get 8 to 10 times their annual revenue will be their valuation. So if you're earning $1 million a year in recurring revenue, then you will be valued at between $8 and $10 million. If you're an infrastructure company, like you're building houses or something, it might be more like, 2 to 3 times. If you're a consulting company, it might be just 1 time your yearly revenue. So there are some standard multiple kind of benchmarks. So you've got to look that up. And there are lots of websites out there that give you a lot of this information. Websites like Crunchbase, PitchBook. You've got to pay for access to those. There are some others online as well. And they will tell you all the past deals that have been done in that sector, and they tell you the companies, and they tell you the valuations, and they'll often tell you how much their revenue was as well. So it's a really, really good source of data if you are going out there trying to raise money and people are asking you, well, what are you valuing your company at? They can be good tools. Just a bit of like a cautionary note there. People often want to push the valuation as high as possible. Like if I'm a founder, I kind of naturally think that my business is worth a lot more than what other like investors might. Just recognize that that it is a negotiation, and rather than me being out there for 12, 18 months and trying to tell everybody my business is 10 million, maybe I'm better off accepting a $5 million valuation, getting some money in, running really hard, maybe, giving away a little bit more equity, obviously, but at least I can get out there and grow my business as opposed to spending my entire time trying to raise funding. So you do have to think about the trade-offs, recognize that the people giving the money don't want to lose it as well. So like you may have built the business, but they've built the money. So it's kind of, you got to respect each other. So just an activity for you, a couple of links here, really good links around how to value a startup, 9 different methods, and even how to value a startup company with no revenue. So as a team, have a look at those and then try a couple of those different methods. Think about what's the most appropriate method for valuing your company based on where you are, whether you've got revenue or not. And you will find that there are potentially some very big differences in the valuations that you will get out of those different methods. And so often, like I said, you've got to do it a few different ways so that when you are pitching to somebody, you can say, well, look, based on the Berkus method, it was this valuation, but based on comparables, I think it's that. We think it's probably somewhere in between. What do you reckon? So yeah, have a go. As a team, use the VC method to value your venture and discuss how a VC will look at the opportunity and what are the similarities or differences. And then, when you're talking to your coach or your trainer, have a think about what valuation method might be best for you as well. So have a go at that. And yeah, see how you go. It'd be good to hear